the S&P 500 has hit another all-time high. Today is Tuesday. Yesterday was Monday. On Monday, it hit an all-time high. On Tuesday, it hit an all-time high. It's hit an all-time high. The S&P's hit an all-time high almost 1 out of 3 days in the market. Out of the trading days in 2021, the S&P 500 has hit an all-time high almost 1 out of every 3 days. This week, it's 2 for 2. Last week, I think it was 4 for 5. Like, if this was a batting average, the S&P 500 would be in the Hall of Fame, right? It just keeps hitting all-time high after all-time high after all-time high. And so what that tells you is not only is that a tailwind to a stock like MicroStrategy, but it's also showing you asset prices are being inflated. And if those asset prices continue to go up, also the price of goods and services are going to continue to go up. And so we have all-time highs in the S&P 500. We have all-time highs in the Fed's balance sheet. Again, we were over $8.3 trillion last week. And then we have all-time highs, at least in the last decade, for CPI. And we have 30-year highs in core inflation. Everything is hitting these high points. And so if you think of CPI, for example, it's not an all-time high, it's a 13-year high. And then core is a 30-year high. You have to do something. But to see the S&P 500 continue to do this, I mean, this is a parabolic, may I say, curve here, where it just seems like it just continues to grow up and up and up and up to the point where literally it's on fire. Like it's like if you used to play, what was the video game where it'd be like you're warming up and all of a sudden once you hit 3 shots in a row, you just couldn't miss from anywhere in the game. That's what the S&P is, yeah. Right? The S&P 500 is on fire. You literally can't miss. It's going to continue to hit all-time high after all-time high because the second it appears that the market is going to crash or there's going to be some sort of correction, you literally are going to get the government and others stepping in and saying, we're going to use monetary and fiscal policy to prevent any sort of market correction or market crash.
What can they do, though, besides they've lowered interest rates so much that they can only print money?
Well, they could go negative, but there's a religious aspect to going to negative interest rates in the United States. We see in Europe and other places there's negative interest rates. So for sure, it's an option. You can do it. And there's people here in the United States who believe we will go to negative rates, right? But then they also can use monetary or fiscal stimulus in terms of actually injecting more capital. So if you think of interest rates are an incentive, right? If I allow the interest rate to drop enough or I push it down, then what it does is it incentivizes you to come borrow money because obviously it's cheap capital. The other thing I can do is I can simply just hand out the cash, right? So if you think about the airline industry, for example, they got handed $25+ billion last year, and 2/3 of it they got to keep for free, right? Nobody got any equity. There was no paying it back. There's no interest. There's nothing. Just you get the tens of billions of dollars for free. On top of that, you then look at things like the housing market going up and going nuts, right? If you look at the stock market, this is all because of the policy decisions that are being made. Most companies are not better off today than they were a year ago, right? There are some, like the technology companies, who have benefited. But if you start to understand what is actually driving this market, it begins to ask the question. If you're a value investor and you've been a value investor for your entire life, you would look at the multiples in the market and you say, this is out of control. There's no way that these valuations are sustainable. We're at kind of record numbers in terms of valuation or some sort of PE ratios, all that type of stuff. It has to come down. It has to revert to the mean. It has to come back to kind of a normal valuation framework. But I don't think that that's necessarily true. Again, I don't know what's going to happen. I'm not a public stock investor, so I don't really spend that much time kind of thinking about which stocks to buy, which ones don't, which ones are overvalued, which ones aren't. But what I do know is that just because historically that's been the average doesn't mean we have to go back there, because the thing that's changed is pre-2008, 2009, there was not this appetite for intervention in markets, to have central banks step into the market and completely manipulate it back up to prevent the short-term pain. Now that we have this type of appetite, you can see that investors are just going long. Like just get long and shut up, and they're just going to pump stock prices to the moon. And that's what we're seeing Michael Saylor understand in terms of if you're going to do that to the stock market and other assets, and inflation is going to hit these kind of 10 or 30-year highs, I have to do something with the cash, Where do I put it? He evaluated all of these opportunities. He put it in Bitcoin. And from his first purchase, he's up almost 500%. From even some of his recent purchases, he's up. And so for an average price of $26,000, $27,000 to have put $3 billion to work and to be up $20,000 per Bitcoin that he's bought, seems to be a pretty good strategy so far.
Do you think that what we're seeing now is similar to what we saw in the financial crisis of 2007, 8, and 9? So I'm looking at the PE ratio of S&P, and it basically dipped down to like 17 and 21 in 2007, 2008 respectively. And we're back up to, it went up to 70 in 2009 at the start of 2009. But we're back up to, I think, a 38 right now. So are we just seeing, like, did they manipulate the markets then, and that's exactly what they're doing now?
So if you go back, let's use gold as an example, right? In 2008, the summer of 2008, gold dropped 30%. There's a liquidity crisis that played out, right? We had a housing crisis. There was uncertainty and chaos in the markets. So investors got scared. They sold whatever assets they had. They sold their stocks. They sold their gold, whatever assets they sold. And they wanted dollars. So if you think about almost a weighing machine to some degree, right? The asset gold is denominated in dollars. So if the price goes down, that means that the dollar is getting stronger and the gold, per ounce is going down. So you're getting a strengthening dollar. The vice versa happens if the price goes up, the dollar gets weaker and the asset gets stronger, right? It's a relationship between the two. When gold sold off 30% in the summer of 2008, the Fed stepped in. Obviously, everyone knows kind of the global financial crisis story. And at the time, it was hundreds of billions of dollars of stimulus. And so gold then proceeded between 2008, the bottom of that 30% sell-off, to 2011, about 2.5 years or so. It hit an all-time high. So it took an entire summer for the liquidity crisis, and then it took 2.5 years for gold to hit an all-time high as a response to all the stimulus going through the market, et cetera. What we got in 2020 was the exact same mechanism on a highly compressed time frame. So what happened was in March of 2020, all asset prices were selling off. Gold sold off 15%, stocks sold off 30%, Bitcoin sold off 55% or whatever it was. And all of a sudden, you get the intervention in the market. So the Fed, you got monetary and fiscal stimulus, all this stuff kind of comes in. Immediately, there was about a week and a half, 2 weeks of a drawdown, and then it just skyrocketed. And we were back recovered by the end of April, pretty much. We had already recovered and we were off to the races, right? And so if you think about the recovery time there, it just happened so much faster. And a lot of that was due to those in power or influence had a playbook this time. They knew, okay, if the market goes down like this and we need to instill confidence and we need to solve a liquidity crisis, we're going to bring like what at the time I was calling monetary bazookas. We're going to drop monetary bombs on this battlefield where there's zero chance that we're walking out of here with anything that looks like an economic crisis surviving. Like we're literally just going to bomb the shit out of the economy. And what did they do? They literally took every single tool in their toolbox. 2 emergency rate cuts to 0%, right? Incredible speed and severity and kind of propensity for action. They then said, okay, we're going to come out and we're just going to start injecting as much liquidity in the market as we can. And so right now, I mean, I remember at one point I said, they're going to end up printing $5 trillion. That's what it's going to end up being. We're already over that. But we may get to $10 trillion. Remember, the Fed's balance sheet in 2008 was $900 billion. Today, it's $8.3 trillion. By the end of the year, it's probably going to come close. Maybe we don't hit $9 trillion. Maybe we do. We'll see. It's 10x in, 13 years, 10 years, 12 years? Like, they were just ready this time. And so when you think about the response, the assets have done the exact same, right? What happened? Assets sold off in 2008, and then they eventually hit an all-time high. It took a couple of years, but they hit an all-time high. We got it in a 12-month period, basically. And now, the stock market cannot help itself. 1 out of every 3 days of trading in 2021, the S&P has hit an all-time high. 1 out of every 5 days of trading, the Dow Jones has hit an all-time high. Crazy. I'm sorry, I think it's NASDAQ. Yeah, NASDAQ 100. I think it's 1 out of every 5 days. Hey guys, thanks so much for watching that clip of the Best Business Show. Make sure you like and subscribe to the channel, turn on notifications so you know when we go live every weekday, and then head to SoFi.com/pomp so that you can get an account and we can get after it.